I am in the hold-off camp. I mean, have been for that. I think they will probably hold off primarily because the job numbers were not that great in the latest one, although they revised the prior two slightly ahead. But there's no signs of inflation yet, meaningful ones. On top of that, they understand that the lift-off might actually cause a decimating performance on emerging markets. On the other hand, if going back to history, going back last 25 years, if you look at every time there was a sustained rate hike, the dollar did its best up to the point of the first rate hike. From then on, the dollar kind of weakened. So it is essentially buy on the rumor, sell on the news. And so that's where you kind of can be optimistic that actually when the rate hike comes in, it will not be that decimating what people are expecting. This is not 2013 summer anymore.
All right, let's follow up on that. They don't move next week. What sort of tone do you think the statement is going to strike? Because the pace of tightening is absolutely critical, isn't it?
Absolutely. So, I mean, you have heard conflicts amongst even the Fed governors. I mean, from what you have heard from Stanley Fischer and others, it has been contradicting is that it's not going to be a sustained hike. So what I expect is whenever the hike comes in, it will probably be a couple of hikes and then a wait-and-see mode. It's not going to be quarter after quarter where they keep on hiking incessantly because the economy is just not that uniformly strong so far.
Are we ready out here in Asia is the big question, because there's a sense from my perspective that there's more pain to come for EM assets, especially Malaysia and Indonesia.
Absolutely.
If policymakers don't make the right decisions, is there a risk that we repeat 1997 all over again?
I think we will not be that much as much of a risk as 1997, primarily because the debt composition has changed. It is not so much foreign denominated debt. It will be like some of the capital outflows which you will see, but it is not that it's going to cause a debt crisis. But you are spot on those two countries. It's Malaysia and Indonesia amongst all the Asian economies which are at its weakest. On the other hand, India, which was actually took a beating in 2013, is in a much more solid footing, almost double the reserves than what it had.
I've been hearing that a lot. That's where you get the uncorrelated returns. It's in India. But from a valuations perspective, it's not cheap, is it?
It's not at all. Primarily because the way the index is, it has a lot of the banks and the energy-related companies, which the earnings have not shown up yet. All the Modi's capex-related growth, it has not come in yet. And what you are getting in India is people are actually focusing on the exporters. They're taking advantage of the Indian weak currency. They're looking at the recovering developed markets, and that's where India's growth is. And so if you look at companies like Infosys or the pharmaceutical names, I mean, those are what is driving the Indian market, and that's what's attracting the flow.